Hello, everybody. Welcome to our May webinar. I'm Betsy, the marketing coordinator here at Elevate Wealth Advisory. And today we are having our founder, Chuck Vickery, who founded our firm in 1982, as our featured speaker. Chuck will be talking to us about what we like to call spend down, but we've changed the name over the years to make it more understandable to people like me that might not always get the financial jargon. So today, Chuck is going to talk with us a little bit about strategies for retirement transitions. He's going to focus on the tax aspect of that. You know, when people think about retirement, they ask, do I have enough saved? But Chuck brings us a better question today, and it's how can I use what I've saved wisely, pay less in taxes, and leave a lasting impact? That's what today is all about. So I'm so happy to introduce you all to Chuck. Chuck, take it away.
Great. Hello, everybody. Glad you're here. As Betsy said, we originally called this Spin Down, and then we changed the name to Strategies for Retirement Transitions. And there are 4 phases that we go through throughout our lives. And the first one is the accumulation phase. And the accumulation phase starts when you get your very first paycheck, and it ends when you get your last paycheck. And this is the time where we accumulate our assets. And then we enter what we call the transition phase. And this is a very short phase. It starts when you get your last paycheck and it ends when you turn 70 or 73 or 75. And the reason it ends is you have to start taking your Social Security at age 70, and you have to start taking distributions from your retirement accounts, depending on your date of birth, at either 70 or 73. But it's a very short time, and this time, this is where we can try to go back and fix what we didn't do right while we were accumulating money. And then once we are forced to start taking our money and our required minimum distributions, and that's why we called it spend down, because the government forces you to start spending this money. They don't really force you to spend it, but they force you to take it out and pay taxes on it. And basically, the distribution stage is where you use the assets you accumulated to provide for your retirement income. And then we hope that's a long phase, because the last phase is legacy. And that's where your assets are passed on to your heirs or other charitable causes. And normally when we're doing this spin down, we talk about life coaches for life and health, stay mentally and physically active. We talk about investments. We talk about taxes. We talk about not only income taxes, but estate taxes. And we talk about risk and making sure you don't have assets unjustly taken away from you. We talk about what risk is appropriate for you. And then you'll see stars on here. And this is where we bring in other experts for collaborative moments. It could be CPAs, it could be attorneys, it could be mortgage brokers. It could be people helping us find assisted living. It could be whatever. People that have better expertise than we do in areas that impact our clients. But today we're going to talk a little bit more at a deep dive about taxes, estate taxes and income taxes. And when risk, we know that risk and return are related, and beta is how much risk we're taking, and alpha measures how much more you get without taking more risk. So we call this tax alpha opportunities. And tax alpha strategies are basically how do we enhance after-tax returns by reducing your tax costs. So you've all worked very hard your entire life to create wealth. So what do you want to do with it? Well, there's only 4 things that you can do with it. You can transfer it to your heirs. You can transfer it to a charity. You can transfer it to the Internal Revenue Service, or you can spend it. So what we think is important is that you should die with the right assets in order to create a step up in basis and realize ordinary income at the very possible lowest rate, if that can be done. And we do tell everybody to seek professional opinions. based on their personal situation because everybody is unique. Now, as we go through this, there should be a little question box at the bottom of your screen. If you have any questions, don't hesitate to click on that and type in your question, and we'll answer those at the end of this presentation. So these are the four things we can do with money: transfer it to our relatives, our children, our grandchildren, the charity, the IRS, or spend it. And so let's talk a little bit about transfers and how they work, and specifically transfers to our heirs, because that's the transfer that we most care about. Okay. So in this country, if you die, there may be an estate tax. Now, we're very fortunate. It's gone up over the years. It's now $13,990,000 per person. And that means you can give away essentially $14 million without paying any federal estate tax or inheritance tax. Once you exceed that, the tax is 40% on all dollars that are transferred to other people at your death in excess of this $14 million. Some people try to avoid this tax if they've been successful by giving away assets. Well, there's also a gift tax, and the gift tax is also 40% on anything above $14 million. Now, there is an annual gift exclusion of $19,000. So you can give $19,000 to any and everybody you know if that's what you want to do, and you can do it every year, and there is no tax on it. If you're married, you and your spouse can make a joint gift of $38,000 to anybody you want to give money to. And who do we give money to? Normally it's children and grandchildren, or maybe a relative, possibly a close friend, but normally children and grandchildren. And other times people will say, well, my children are doing really well, so I don't really need to leave them this money, so I'll just leave it to the grandchildren. Well, that's called a generation skipping tax. And the same applies here. You can leave $14 million to your grandchildren and not pay any taxes. Anything above that, again, is taxed at 40%. So I want to talk about some key points on these federal estate taxes. And these points are portability, which is relatively new. We want to make sure you don't disinherit your spouse. We want to get a double step up in basis. I want to talk to you about what happens if you just hold your assets. I'm going to talk to you what happens if you need to borrow. And I'll talk to you what happens at your death. So let's talk about these. And the first one is portability. And again, this has only been around for 4 or 5 years. At the death of the first spouse, the unused estate tax exemption, the $14 million, is available to use for the second spouse. Now, it used to be it was a use it or lose it deal. If you did not use your exemption, it was just wasted, and your spouse had his or hers, but only his or hers. So now the surviving spouse can use the first to die spouse's exemption as well as their own. So it's $28 million. And for most people, that doesn't really mean a whole lot because most of us don't have $28 million. Okay. There is an unlimited spousal exclusion, which means you can transfer all your money to your surviving spouse. And they get the credit. But to do that, you have to fill out a Form 706 estate tax return at the first death. You don't have to pay any taxes. You just have to fill out the form. In the future, we don't know what the laws are going to look like. They could be higher, they could be lower. These numbers have changed quite a bit over time. But right now, most people really aren't concerned about estate taxes. But it's nice that you get to use both yours and your spouse's. And then we talk about disinheriting spouses. This is not something that anybody wants to do intentionally. But what we are finding is that some people have estate documents that were done quite a while ago, before the exemptions increased to where they are now. So do y'all remember Y2K? It doesn't seem like that was 25 years ago, but it was. And in the year 2000, the Estates Act estate tax exemption was $675,000, and there was no portability. So if you left everything to your surviving spouse, there was no estate taxes. But at your surviving spouse's death, I'm assuming the man dies first, she only had $675,000. And at that time, everything above that was taxed at 55%. Well, when George Bush II came in, he bumped those numbers up to $1 million, then eventually up to around $3 million. And then Obama came in and he made it 5 million, and then he also tied it to inflation, so we'd have cost of living adjustments. When Bush came in, when Trump came in, he bumped it up again. So we've had these going up, but they've always been changing. But back 2015, 20, 25 years ago, what most attorneys did under the old law, because again, it was a use it or lose it. They would say, in my death, I want my assets equal to the exemption to go into a family trust. And that trust is going to be used to support my spouse, and everything else goes to my spouse. And that was done as a way to reduce estate taxes. The problem with this is it does not provide a step up in basis on the first death at the second spouse's death. So what we have now seen is, because these exemptions have risen so, if you have a will like this, it basically takes all your assets up to $14 million and it puts it in a trust. Now, there's a step up in basis at the first death, but there's not one when the surviving spouse dies. And the surviving spouse does not have access to this money. They get income from it, but they can't give it to anybody else. They have no control over it. It's almost like they're disinherited. All over there, it was done to reduce taxes and to tell your surviving spouse, I love you. The surviving spouse had no control over that money or what happened. So if your estate tax document is old, it needs to be reviewed, and possibly under today's laws, a simple will removing that trust, that family trust, might be a better option. So you've heard me talk about step up in basis. What is step up in basis? Well, when you have assets that you own, at your death, those deceased spouse assets step up to fair market value. So I'm going to give you both a good example and a bad example. And the example is your house. If you own your house at your death, your spouse inherits it, and your spouse can sell it, and they do not have to pay any taxes on the appreciation of that house. That's also true for other real estate other than your residence. That's true for stocks. That's true for bonds. That's true for art. That's true for anything. So when we say we want you to get a double step up in basis, at your death, those assets that have appreciated, we want them to step up so that your heirs can sell those and use that income to live on if they need to without paying any taxes. So we do a transfer of those assets to the surviving spouse. The surviving spouse can liquidate those assets and not pay anything. If they like the assets and they want to keep what they inherited, they only pay taxes on any appreciation between the first death and the date of sale. And then at the second death, we want to get a double step up. We want another step up to happen for the children and the grandchildren at their surviving spouse's death. So we want to get a double step up so that we're paying as little in taxes and capital gains taxes as we can. One way to avoid paying those taxes is to never sell. Just avoid selling assets with significant appreciation during your lifetime. Just hang on to them. As your house appreciated, as your stocks appreciate, as your real estate appreciates, you don't pay any taxes on the appreciation. You don't pay any income taxes on the appreciation until you sell it. So what we want to do is build unrealized gains. That's what that's called. When you pay $1,000 for a stock and over years it turns into a $10,000 stock, that's an unrealized gain and you don't pay taxes on that. And at death, it steps up so that your heirs get it at that $10,000 level or that 100,000 or that million, whatever it's worth at that time. So just holding on to assets lowers taxes. Another way that we can give assets away during life if we want to is by using cash or assets with low unrealized gains. So when you give cash to somebody, what did that cash, when you've got money in the bank, you've already paid taxes on that. And when you make a gift of 19,000 or 38,000 or $1,000,000, the person that receives it does not have to pay any tax on that cash. Now, if you give them something that has low unrealized gains, maybe it's an asset worth $100,000 and you paid $90,000 for it. Well, when you make a gift during life, the cost basis goes with it. So if you give away that $100,000 piece of real estate or that $100,000 stock and you paid $90,000 for it, if you sell it, you'd have to pay a $10,000 long-term capital gain. If your heirs sell it, they have to pay a $10,000 capital gain. But you don't want to give away something that's worth $100,000 that you only paid $10,000 for. Why? Because the basis is $10,000 and your heirs have to pay tax on that $90,000 gain. Okay. So you don't really want to sell that highly appreciated asset that's got all those large unrealized gains that are going to receive a step up in basis at death, and there'd be no taxes due on it. So if you don't have cash to give, or if there's not anything with low gains available, maybe rather than selling that highly appreciated piece of property, you go borrow the money and you pledge the asset with a large unrealized gains against that. And that way you've got the money to give cash because you don't have to pay tax on loans, at least not yet. You do have to pay the interest, but you don't have to pay any tax on the loan. But you can give that asset to your heirs, maybe to help them buy a house or a car or whatever. Okay. So then when you die, you avoid capital gains tax via the step up in basis at death. And if you have made pre-death transfers funded by borrowing, then that debt can be paid off from those assets being sold with no income taxes due on them. And then if the heirs continue to own that asset, the step up in basis will lower their taxes in the future. So when you gift asset, the basis goes with it. When you bequeath an asset, it goes in at current market value, and whenever it's sold, that's the basis for the heirs. If it's sold immediately, no taxes. If they hold on to it for 10 years, they only pay taxes on the appreciation of that. So that's the estate tax part of it and the gifting part of it. So let's take a look at income tax opportunities. And when we talk about income taxes, there's 4 or 5 things I just want to mention here. $212,000 modified or adjusted gross income is the surcharge for, is the surcharge for Medicare. And it's called IRMA. And IRMA is income related monthly adjustment amount. So when you turn 65, you will go under Medicare. And Medicare, you have to pay for it. But the cost is not based on your age, it's based on your income. And the more money you make, so for a couple with a modified adjusted gross above $212,000, they get to pay an extra couple of $1,000s a year. And that goes on up to where they potentially could pay $7,000 or $8,000 or $9,000 a year more from Medicare. So we like to take a look in retirement at that $212,000 number and make adjustments in that whenever and wherever we can. And then the 250,000 modified adjusted gross income, this is the additional 3.8% Medicare surtax. So if you have a lot of investment income, you're going to pay an extra almost 4%. And this was under Obama to pay for Obamacare. That's the purpose of that. And then under the Tax Cut and Jobs Act of 2019, we have qualified business income deduction. And the threshold for that is a $483,900 taxable income. So if you have a business and your net profit is less than 483,900, you get a 20% reduction in that. So just the number there. And then we have different types of taxes. We have ordinary taxes, which are the maximum taxes, and we have capital gain and qualified dividend taxes. And those are tax preference items, and they're a good bit lower than ordinary taxes. And they start at 0, then they go to 15%, and then they increase to their maximum 20% once your income hits $600,050 of taxable income. And then just so you'll know, the highest income bracket is 37%, and you hit that at $751,000. So just a little bit about income taxes. So when we're doing tax alpha strategies, it's the intersection of tax and finance. And what are we looking at when we're looking at this intersection of tax and finance? Well, we want to focus on losing the least of taxes in a lifetime. Not just this year, but over your lifetime and maybe your heir's lifetime. What can we do to limit our taxes? What can we do to avoid portfolio taxable gains? There are certain things you can do. We don't have control over a lot of things, but we do have more control than you might think over your taxes. And we want to understand the tax treatment of different assets and what the tax cost of owning different assets is. And then we want to manage our tax cost not only while we're accumulating money, but also when we're retiring and living off of that money. So let's look at managing income thresholds. So we want your goal, if it's to pay the least amount of taxes I can this year, we want to change that to paying the least amount of taxes over your lifetime and losing the least amount of wealth over your lifetime to taxes. So we want to focus on spreading income and expenses maybe over the next 3 to 5 year period versus saying, I'm going to do everything I can this year to save a little bit in taxes, and I'll worry about next year later on. Okay, that's sort of the traditional way of doing it. And we think by looking at where you are today and where you're going to be in 3 years, 5 years, 10 years, and maybe volunteering to pay a little bit more tax this year is better than being forced to pay a much higher tax on down the road. So we also want to manage the recognition of tax deferred income. So when we say tax deferred, it's not tax free, it's just deferring taxes on down the road. And there are certain times that it's better to recognize some of these taxes. For example, traditional IRAs, their required minimum distributions, your pension plans, annuities that create ordinary income, Roth conversions, you have to pay tax when you do those, double E government bonds. These are all great things to take a look at when you're in that transition period. I've quit working, but I'm not forced to take my Social Security and I'm not forced to take money out. And usually that's a period of time where your income is relatively low. And we say that's when the magic happens. That's when we can go in and take things that have built up big tax hits and take them out while we're in a very low tax environment. And then there are times we want to look and maybe manage the payment of deductions. Could be contributions, state income taxes, property taxes. Are there ways of things that we're going to pay every year that we get no credit for because the standard deduction is so high? Are there ways that we could bunch these things together so that at least one out of every 3 years we get a pretty nice write-off? So we look at that and we work at that when we're looking at income taxes. So, and we want to avoid just creating taxable capital gains for the sake of creating taxable gains. And to do that, we think you should be using a tax efficient, multi-factor asset class investing so that we can capture risk adjusted after tax market returns. And we're not really talking a lot about investments today, but we talk about asset classes. So I want to talk just briefly the estimated probability of outperformance. We know the stock market outperforms CDs and treasury bills. And over a 1 year period, it does it 65% of the time and 79% of the time over a 5 year and 86% of the time over a 10-year period, stocks beat cash and beat savings account. And over a 10-year period, we know that small stocks outperform large stocks. We know that value stocks outperform growth stocks. And we know that high profitability companies outperform low profitability companies. And you can see the percentages here. But the probability of outperformance increases over time, but it's never guaranteed. But we want to build these factors into a risk portfolio, risk adjusted for after-tax market returns. And one of the things that we need to focus on are, what do these investments cost? What's the tax cost for owning this? And a lot of actively managed funds, the portfolio manager is compensated by total return, and they don't care about taxes. And they may turn that portfolio over 1 or 2 times a year. And anytime you have turnover, it creates gains, and those gains you have to pay taxes on. And I tell people, don't pay taxes on money you aren't spending. So let's take a look at the transaction cost that's going on, because when they do that turnover, somebody has to pay that, and that reduces your overall return. What's the management cost? Is it 0.1%? Is it 1%, 1.5%, 2%? We have found that the investments that have the lowest management cost often give you a greater return. Why? Because you're keeping that money, you're not spending it. And then idle cash. Sometimes some of these managers think they know more than anybody else, and they want to do market timing. Well, I'm going to tell you right now, the Hall of Fame for market timers has exactly this many people in it. Nobody. Because nobody has been able to prove over time that they are efficient market timers. You've got to be right to get out. When you get out, you got to be right when you get in. They may get one right, they'll mess it up. But let's just look. How much does it cost to own this asset? What's the management of it costing me? How much money are they spending that I'm having to pay for? And do I have money just sitting there that's not working hard for me? So our goal is to accumulate growth and unrealized gains so that we can get that step up in basis when we're gone and this money goes on to our heirs. So we really only want to realize these gains if we need to fund our lifestyle. So again, if I've got $1 million asset and I only paid $100,000 for it, but I need more income in retirement, then I'm going to sell little bits and pieces of it and have to pay a little bit of taxes at that time. Or if I've got a portfolio that's 60, 70% stocks, 30 to 40% in bonds, and I haven't paid it any attention, and the stock market's been running, and I look up and I've got 95% in stocks and 5% in bonds, so I'm taking way more risk than I wanted. Maybe I'm willing to pay a few taxes to lower my risk. Okay. And then we also want to, as we own assets and the markets go up and down, we want to look at tax loss harvesting. And what tax loss harvesting basically says is, I bought something, it's gone down in value, so I'm going to sell it at a loss and buy something that looks a lot like it with the same amount of money. So my risk exposure is still the same. My opportunity to increase my money is still the same, but I've got a loss that I can use to offset income taxes for this year and maybe some years in the future as well. And a lot of this stuff comes about because of asset placement. And asset placement is a process of managing a portfolio by matching the appropriate investment asset class to the appropriate tax vehicle to minimize both income and estate taxes. So, what I mean by that is that if something creates ordinary income taxes, then put it where it's sheltered somewhere. And let me give you an idea. So there's three different places that we can put money. One is tax deferred, one is tax advantage, and one is tax free. So by tax deferred, what are we talking about? These are all your retirement plans, 401ks, 403bs, traditional IRAs, simple SEPs, annuities, pensions. So that shelters money from taxation while you own it. So that is a great place to put things like CDs and bonds. Real estate rent is subject to ordinary income taxes. That's the kind of stuff that you want to put in there. The disadvantage of it is when it comes out, it's taxed at ordinary rates forever. And I talked about step up in basis. Well, most things step up in basis at death, except it's called income in respect of the decedent. And that's a fancy way of saying if the government has given you tax deferral, then it does not step up in basis. So for these tax deferred accounts, they're not only fully taxable to you when money comes out, but they're fully taxable to your heirs. So at your death, when your wife inherits this, or your spouse, they're going to pay taxes on it. And when your spouse dies and your children or grandchildren inherit this, they're going to pay tax on it. So then we've got the tax advantage bucket, the one in the middle. And this is basically our personal assets, individual and joint accounts. And we get some special breaks here. So anytime you have stocks or ETFs that own stocks or mutual funds that own stocks, that throw off qualified dividends and from common stocks and capital gains from the sale of things, you pay less tax on that than you do in the ordinary bracket. And the nice thing about these assets are these are the assets that step up in basis at death so that your heirs don't have to pay any tax on it. And then we have the tax-free bucket. This is the Roth IRA, Roth 401k. So this money, you get no tax break when it goes in, but it grows tax deferred. There's no tax on the dividends, the interest, or the growth. There's no tax on this money when you take it out, and there's no tax on this money to your heirs. So I'm talking about ordinary taxes and capital gains taxes. What's the difference? Well, here it is. If you're in a low tax bracket, if you're retired and your income's $120,000 or less, and you have capital gains or qualified dividends, you don't pay any taxes. If it's all ordinary income, you're going to pay 10 to 12%. And then when you get up into the $200,000 to $500,000 income range, you can see the taxes are 22 to 32%. And what are they for long-term capital gain? 15%. That's a significant reduction in income. And then when you get up into very high income levels, 35 and 37%, you get almost a 50% discount on your capital gains and qualified dividends rather than 35-20, rather than 37-20. So there's a real advantage to having long-term capital gains and dividends. But to get this, you've got to put money in this middle bucket, and you've got to buy common stocks with it or something that owns common stocks. So let's just take a look at taxable assets and of all descriptions and sort of how they work. Well, we've got CDs, money markets, treasury bonds, tax treatment. These are taxed at your highest marginal rate. And what do I mean by highest marginal rate? If you have one more dollar in income, what will the tax on that be? 10%, 12%, 22%, 24%, 35%, 37%. So that's your marginal rate. And then if you have dividend income from common stocks, that's the qualified dividends, that's a capital gain rate. And that's taxed at 50, again, $120,000 of income, no tax. 120 to about 200 or 500, 15%, above 500, 20%. And then we have common stocks. What's the capital gain income? Well, it's deferred until you sell it. That stock's appreciating and you don't pay tax on it until you sell it. And when you do sell it, you pay capital gain rates. And at death, it steps up in basis. And then we have real estate. And we're talking here about rental real estate, not your home. Could be building, could be land. You get to depreciate rental real estate. And when you sell it, you have to recapture that depreciation. And that's at about a 25% rate. But you can do a 1031 exchange. When you sell it, you can hold that money. And then you can go buy another piece of property and you don't have to pay taxes on it. So gains are deferred until you sell it, even though we've had appreciation on it. And then we get into tax deferred assets. What are those? Well, these are your pension plans, your 401k, 457, 403b, traditional IRAs. You put money in these. There's tax deferral on the growth. There's tax deferral on the interest. All of these do have a couple of things in common. And one is they have a required minimum distribution. And that starts, again, if you were born before 1960, it starts at 73. Born 1960 and later, it starts at 75. There is no step up in death on these assets. As I said, your heirs pay taxes on this just like you do, and it's all at ordinary income rates. And one of the last things that your successful children want to receive is an asset that has a big tax bill attached to it. And then we run into annuities that are offered by insurance companies. They offer growth tax deferral, but when you take the money out, any appreciation is taxed at ordinary income. And I'm not a big fan of annuities. For certain people, they're great, but the problem with them is they convert low taxes to high taxes. And there's no step up at death with annuities, and all taxes on annuities are at ordinary rates, which are the higher rates. And then we have certain tax-free assets. So, for example, we have municipal bonds, and municipal bonds are issued by state and local governments. That's how they get water systems in. That's how they build schools. That's how they build airports. And when you have a municipal bond, you do not pay federal income tax on that interest. And if it's a Georgia bond, you don't pay Georgia tax on the interest that they pay you. Okay, if it's a non-Georgia bond, state of Georgia or whatever state you're in, if they have income taxes, is going to let you pay tax on it. So, but if it's a local state, it's exempt from state taxes as well. And then we have Roth IRAs. And if we all had a choice, we'd have all our money into Roth IRAs. There's no requirement to ever take money out of a Roth. Again, you get tax-free income, you get tax-free growth, you get tax-free at death. There's no tax on the money. When you put money into a Roth IRA, you're telling Uncle Sam, see ya, this is my money. You have nothing to do with it the rest of my life. Okay. Then we have life insurance. And life insurance, permanent cash value insurance, gives you tax deferral. If you cash it in before you die, you may have to pay some ordinary taxes. But at death, if you have a named beneficiary, that person receives those life insurance proceeds income tax free. And then we have a step up in basis, and this applies primarily to common stocks and real estate. Somebody asked me one time, why doesn't it apply to my CDs or my money markets? Well, the reason is your CDs and money markets are taxed every year. So they're already at their highest basis they possibly could be. But common stocks and real estate step up in basis so that they can be sold by your heirs without having to pay any taxes on that value of the money. So there's how do we manage things during the retirement phase? Well, we always like to do a plan, and we like to look at where we want to go. So we like to start with the end and then work our way to that. And so when you're retired, how do we fund that lifestyle? Well, there's certain mandatory retirement incomes that you've got to do. For example, Social Security. You can start as early as 62, but you have to start at 70. You don't have to, but if you don't start at 70, you're just giving away money. You don't get it. So we've got to take Social Security. Pensions start when we retire often or at a certain age. We have required minimum distributions from our IRAs and our 401ks. So that's the first place that we get money from, those things that we have to take. Then we take a look at our that middle bucket, those taxable income dividends. So when you get dividends and capital gains that are not in the retirement plan, whether those are reinvested or whether you take those in cash and spend them, they're both taxed exactly at the same rate. So that's our second phase of getting income. And then if we still need more, then we go in and we start taking a look at the assets we have that do not have high appreciation on them. Then we start whittling off just a little bit of those because they don't create very much in tax. And we supplement our income to get us to where we need to be. So that's how we manage tax costs during the retirement phase. Now, we look at asset placement, and I mentioned this briefly with those buckets. So ordinary income, that's that OI asset classes and tax deferred structures. So CDs, savings accounts, bonds that are not tax free. Those are type of things that we want to shelter so we can put those into a traditional IRA or into an annuity. So we want to match our ordinary income asset with things that create ordinary income. And what that does, quite frankly, is it gives us lower growth. So on those assets, and that lower growth reduces how much money we have to take out. Okay. Now, with proper asset placement, you have the same growth rate, but your tax rate is much better. Don't volunteer to trade low taxes for high taxes. And if the government owns up to 40% of your IRA, which is what the tax would be if you cashed it all in at one time, do you really want that to be your highest growth account, your growth engine? Don't you want your highest growth account to be the one that receives tax preferences and taxes are much lower? So again, here's the tax rate. We talked about them. Do you want to be in this ordinary rate column? That's where your Social Security, your pension, your RMDs are. So we don't have any control over that. That's why we called it spend down, because you had to spend it. You're now in the distribution phase. You're forced to do a lot of different things. So, but let's get as much money as we can over in this capital gains rate and qualified dividends rate. And asset placement is sort of the secret to that. So we want to take assets that appreciate and create capital gain in taxable or tax-free structures, like that middle bucket or that Roth account. So the advantages of this is your return doesn't change. It's just your taxes go down. So we're going to position our higher expected growth assets to lower taxes. And we want to position our equity so that we get a step up in basis. And if you have foreign stocks, they always collect the tax on that. You get that back if it's in a individual or joint account. You don't get it back out of a retirement account. We also want to position for capital loss harvesting. And again, you cannot do that in retirement accounts. You can only do that in joint or individual accounts. And then we want to avoid capital gains by using what we call evidence-based investing approach. And these are basically low turnover, low cost assets that are very tax efficient, and they aren't always selling everything, and the asset continues, the unrealized gains over time just get bigger and bigger. And we want to increase unrealized gains by diversifying as early as you can. Matter of fact, for those of you in the accumulation phase, we say save as much as you can, as early as you can, and diversify. those assets. So we get back to these buckets and we want to use them to our advantage. So as I talk with people and clients and assets, and I spend my day working with clients and prospects addressing their most significant concerns. And if I could summarize those assets, I would put them in 5 categories. They want to make smart decisions with their money. They want to minimize income and estate taxes. They want to have an interest in transferring assets to the next generation at the lowest possible cost. They have concerns about third parties unjustly taking their assets, and they have interest in making significant charitable gifts. Now, if you go to our website, elevate-wealth.com, we've got other webinars that we have done on how to make charitable gifts that impact the charity and benefit you the most. So if I could summarize what we've talked about today, our goal is to help clients minimize taxes by moving tax planning decisions from W-2s and 1099s and worrying about this year's tax return to that intersection of tax and finance, where we have tax management and true wealth management coming together and everybody wins. And why are we talking about taxes in May? Because we can't do it in January and February. We've got to plan it out. And if we do that, it works well for you now, and it works well for your heirs later. So I want to thank you for joining us today. If you have any questions or we can assist you in any way, please feel free to reach out to Elevate Wealth Advisory. And so, Betsy, I'm going to turn it back over to you at this time.
Huck, thank you so much for that. And the more I listen to your presentation, the more I realize it's not just people retiring that need to hear this information. It's anybody, from your first paycheck to your last. So I think if anyone watching today, if you want to share this, not just with your friends, but your children and maybe even your grandchildren, I think it's great, important information for everybody just to learn how to pay the fewest amount of taxes over your lifetime. Thanks again, Chuck. It doesn't look like we have any questions, but if you do, like Chuck said, just reach out, visit elevate-wealth.com and click Let's Talk. And we will look forward to seeing you next month as our advanced planning coordinator, Dee Dee Bloom, talks to us about advanced planning topics. Thanks again, Chuck. We really appreciate you as always.
Okay. Thank y'all. Good seeing you.
Take care. Bye-bye.
Bye-bye.